Okay, this is yet another supplement to our classroom learning. We're going to do a little bit of Chapter 11 here, and I've highlighted some of the parts of your textbook actually as presentations here. We're going to be talking about portfolio income, interest, and dividends. Let's talk about that first. First, Exhibit 11.1 has been discussed before. For purposes of preparing for the final, make sure that you are well aware of how to approach that particular part of the equation, which is how to figure out the after-tax rate of return on investments that are taxable versus investments that are not taxable. That's the concept. So that if you're looking at a tax-exempt bond, what is the equivalent rate of a taxable bond? And vice versa. That's the idea there. So make sure you know how to do that. That's not just a good thing to have for the final, that's a good tool to know for the rest of your career in the accounting profession. All right. Taxpayers include interest payments they receive in gross income, the actual payments. So if you have an account that is an interest-bearing account at a bank and they post to your account interest earned, they post it to your account, it's there, it's in the account, you pay tax on it when it's posted and credited to your account. That's just a simple concept of cash basis taxpayers. You don't have to actually receive the check in your hand. If it's put to your account, it's considered income when it's there. And it's available to you, and it's subject to constructive receipt, I suppose, but it's even more so, it's actually in your account, in your name. If a bond was issued as a discount, I'm just going to read this, we'll read it together. If a bond was issued as a discount, the original issued discount OID rules apply. This gets a little complex, so basically you're supposed to get the basics of what this means. And it basically means that a discount bond, the way they work, let's talk about how they work then we'll go back to the writing here. You pay for a bond, let's say you pay zero. And you receive a bond, well, that won't work. Pay zero and get a return, I don't think that works. That's too good to be true, which is a lesson if we haven't had in class. Let's go over that right now. If something's too good to be true, it probably isn't. So let's go back to a little bit more realistic example. This discount bond is $25, and the promise by the investment company will pay you back in a certain number of years $100. So you're paying it $25 to receive $100 back over time. That's what's known as an original issue discount. OID rules apply, and that basically means that you're going to pick up interest while you're waiting, while the time is going on. The amortization of interest is accruing, and since you're a cash basis taxpayer, you're not going to be able to dodge out of it because this is really an accrual situation. The tax rules have come along over the years and codified this OID concept that you have to pick up the amortization of the income as you go along. That's what this particular paragraph is all about. And so you'll report the income on an amortized basis. How will you know exactly how much to pick up? Almost all the time that's done for you by the bond issuer or the broker, and they'll send you a Form 1099 OID, that's obviously standing for original issue discount, and you'll pick up the tax when you prepare a tax return. That goes back to our lesson on Forms 1099. You'll be looking for those in addition to Forms 1099 INT for interest, 1099 DIV for dividends. You'll also look for OID, original issue discount. If a bond was issued as a premium, taxpayers may elect to amortize that premium over the life of the bond, which reduces their earnings on the bond. You could do that. Or alternatively, if you don't, it'll reduce offset the bond when it matures from any gain that there might be on the bond. So you can elect to amortize the premium, and that's just a concept that you should know in case you do pay a premium on a bond. It's all, as it says clearly, it's just very simple. The the amortization of the premium will offset the actual interest payments that the taxpayer will include. That means that what happens is that the bond is paying at a certain rate. The payer will issue a 1099 on the rate that the bond is paying for the interest it's paying. Since you paid a premium on a secondary market, this gets to our finance people in the room. If you've paid a premium on a bond that is in the secondary market, and the reason you paid the premium is because the differential in interest rates that day compared to the rate on the bond, so that additional premium can reduce the interest income you otherwise would have to pick up on an amortized basis. Okay. The U.S. savings bonds, you'll read through this, but I'm going to go through and just highlight the key here. This is a really cool area of tax when it comes to investment income. U.S. savings bonds, otherwise known as Series EE, or now the I bonds, they don't pay periodic interest, but they're basically issued at either face value or discount, but they don't pay their interest as they go along. They will pay their interest when they mature. Such as something very similar to a discount bond, very similar to original issue discount. In fact, you could say, and you would be right to say, it's exactly the same thing as original issue discount. However, the interest that is being earned through time through this original issue discount does not have to be picked up on an amortized basis like you do with original issue discount bonds like OID, but you don't have to, but you will automatically by default only pay the interest when you redeem the bonds. So here's one of those issues that we went over in class where you've got to recognize when there's an election, which way does the election go, and what's the timing of the election. So in this case, the election is that the default position, rather, is that you only pay interest on the income earned on the bonds when you redeem it. But when it comes to the election to say, oh, I'd like to include the original issue discount, so to speak, each year, that's an election. That's an election. So the key is you have to decide early on when you first buy the bond, which way do you want to do? And you'll have to read the instructions at the time you buy one of these bonds, or a tax client of yours buys a EE or I bond, to determine which way do you want to report the interest. And of course, the default position of not reporting the interest until you redeem the bond is probably going to be your better bet, because it's deferring the income tax on it. It defers the income tax on it. The last part of this paragraph is another interesting and very important concept when it comes to these bonds. They may be used to pay for qualifying educational expenses, and if they are, then any interest built into these bonds is not taxable. So that's a really cool way to have invested your money. You invest in a EE bond or an I bond, let's say when a child is born, and the child grows up to be age 18 or 17 and goes away to a qualifying educational establishment like the University of Maryland, and you use those bonds, which now have interest attached to them over the time that the bonds have been held, which you otherwise would pay tax on if you redeemed it, but instead you use the bonds. You simply sign those over to the university. They accept it in lieu of educational tuition expense and other qualified expenses regarding the cost of going to college, and you don't pay tax on the interest built up. This is an incentive in the tax law to send people to college, as if we needed an incentive to do that. Okay, and of course the last sentence tells it all as well, that this particular exclusion is subject to a phase-out based on none other than that famous line, the line adjusted gross income. Okay, when it comes to dividends, the thing to remember there is that dividends are, by and large, subject to capital gain rate tax if they qualify. and most dividends do, but be aware of which dividends, if I don't have a slide here for that, which dividends qualify for the special capital gains rate tax. Or you may not. Here's the thing, you don't necessarily have to know all the details of which dividends qualify. Just read that part of the textbook and be aware of the fact that on Forms 1099 DIV, you're going to be told by the broker or the institution paying, the company paying the dividend, you're going to be told how much is qualifying dividends subject to capital gains rate. So when you do your tax preparation, it'll be laid out for you. One other thing I just want to make mention of here is that collectibles, when they're sold, they are, if they've been held for greater than a year, yes, they may be a capital asset, but their capital asset rate is 28% as opposed to the more favorable 20% rate that we've been learning about. It's just a quirk in the law, but it's based on the concept that collectibles, people could make a little side trade or business of them using the capital gains rates when they sell them, keeping them out of the, quote, inventory concept by disguising their activity in a way that doesn't look like a trade or business. So the tax law says, well, just to make sure, we'll tax those at a 28% rate in case anybody's able to hide those from being seen as a trade or business, which is inventory, which would be subject to ordinary income tax rates. So the special 28% rate is kind of an arm of enforcement for the IRS, so they don't have to catch everybody who may be trying that. Notice the qualified small business stock of whatever that is. If it's held for more than 5 years, it's subject to some special tax rates or tax deferral. Just read that and put it in the back of your head. I'm probably not asking too many questions on that, if any, but the main thing is to just know that it exists. We don't see it in practice too often, which is why I'm not emphasizing it. And also, you'll probably be aware of it through the brokerage house. They'll probably let you know, but just be aware of it nonetheless. Okay, we have mentioned this, but we haven't really spent a lot of time on it, the fact that there is tax-exempt portfolio income, and I think most of us now have, at least from the little bit that we've touched on in class, the knee-jerk reaction that it refers to municipal bond interest not being subject to federal income tax. What I wanted to add here is that you should note that that's true. We have a reciprocal arrangement in the law. It's based on some constitutional concepts, but it's been statutorily agreed upon by the states and the federal government. The states do not tax U.S. interest, and the United States government doesn't tax state municipal bond interest. Let me say that again because it relates back up here to these EE and Series I bonds. When it comes to this reciprocal arrangement, the federal government will not tax municipal bond interest. That's bonds issued by states and the District of Columbia and Puerto Rico. The federal government won't tax those for income tax purposes, the interest earned on those bonds, and vice versa. The states, District of Columbia, Puerto Rico, and maybe a couple other U.S. possessions will not tax at the state level the interest earned on federal obligations. So that means that EE bonds, Series I bonds, and Treasury notes, Treasury bills, anything issued by the federal government that you can invest in and earn interest, they have a reason to be computed according to that original formula up here, that there's a certain amount of tax that is not being paid on those. That's the state and local tax, depending on where you live. And therefore, their rate of return after tax is a little greater than a normal taxable instrument that's taxed both at the federal and state level. So in summary, you've got EE bonds, Series I bonds, and a whole bunch of Treasury instruments that you can invest in that won't be taxed at the state level, and that's really cool. Municipal bond interest, on the other hand, won't be taxed at the federal level, but they won't be taxed most of the time. This is what I want to point out here. So pay attention for a second here. Most of the time, municipal bonds will not be taxed in the state that they are issued. I think that's true everywhere. So if you buy a Maryland bond and you live in Maryland, you will not pay Maryland income tax, and you won't pay federal income tax on the interest earned on that Maryland bond. But that's not true. Most of the time, that's not true if you buy a Pennsylvania bond and you live in Maryland. True, you won't pay federal income tax on the Pennsylvania bond interest, but you will pay Maryland tax on the Pennsylvania municipal bond interest. So that's what I want to point out there. And those kinds of questions about where those federal government bonds get taxed versus where the municipal bonds get taxed, both at the state or federal level. Those are kinds of questions that should be fair game, even though state income tax is not the highlight of this course. This is a tax principle that you definitely need to take away from this course when you get involved in a tax department somewhere someday. All right, educational savings plans. I'm going to mention this, and the reason I mention it is you should not leave a tax course like this without knowing what a Section 529 plan is, at least in the very basic sense. And the very basic sense of a Section 529 plan is it's similar to the EE bonds or the Series I bonds, where you put money into an account for the benefit of a child to be with the intention that the money will be used for their college education. And the result being that you are going to tend to want to put that in to a child's name early in their life, so there's a larger buildup of income from that instrument. And here's the couple of keys. Let's get these out in the open. You put the money in a 529 plan. While it grows from whatever it's growing from, whatever kinds of investments you designate them to be, there's no tax while it grows. So it's a tax deferral instrument. If the cashing in of the proceeds from the 529 plan is used for college education, higher education expenses, it is then exempt from tax when it comes out. It can't get any better than that because it's then completely tax-free earnings. So today, when you have, even though you have very low interest rates of return, but you got high rates of tax, it's even more important, perhaps, I suppose, to consider 529 planning. It's just a great way of putting money aside for children to be used for college education. If it's taken out and not used for college education, it is the earnings that were earned inside the instrument and tax deferred will be taxed, plus there'll be a 10% penalty because it's going to be considered a gift at that point. That brings me back one more time to EE and I bonds, which had the same concept, but note well from your text to see if it discusses it. I believe the qualifying education expenses here are not limited to college education, but can be used for K through 12 as well. Check that out, see if I'm right. Somebody let me know in class, and if I'm not right, well, we can have fun with that too. Okay, so 529 plan is also used, by the way, by wealthy individuals as a way of gifting money to beneficiaries, because it is something you're allowed to do as a gift, and you can, well, it gets a little complicated because it really gets to estate and gift tax, but for those of you who've been following when I delve into the estate and gift tax during this course, the 529 plan allows you to give 5 years of your annual exclusion all at one time. So that's a pretty powerful way to give away some wealth, because you can do it today. You can do 5 years of annual exclusions to somebody today. I'm not going to ask that on the test, but just wanted to impress upon you that 529 plans are something to be looked at. Each state has a 529 plan. That's where you'll find them. They have different rules. Some are maybe better than others. If I were asked, and if I were asked by a client, where should they invest? Which state should they invest their 529 plan in? I would probably go to Consumer Reports, which I'm not here to advertise them, but they do an excellent job of breaking down an analysis of the 529 plans in the various states. Maryland gives a deduction on the state income tax return. It's a small deduction, but it's nevertheless a deduction that also makes it sort of, I would say, interesting to use the 529 plan. But the thing is that each state's plan relegates the investment vehicles to whoever the state chooses. For example, those of you in finance, just as for you, Maryland uses T. Rowe Price. Some states use Fidelity, some use Vanguard, and they come in all different varieties. The federal tax rules stay the same. So even though the states have varieties in their plans and variances, the federal taxation stays the same. Okay, so portfolio investments, this is sort of a summarization, I suppose, of some portfolio investment expenses. This is a summarization of a concept, again, we mentioned before, but this is what Chapters 11 is about, so let's delve into it, which investment expenses have limitation. What we call portfolio investment expenses have limitations. And if you're not familiar with what we mean when we say portfolio income, check it out in your text. It's been mentioned in class. It's important for you with the final to understand the baskets of portfolio income, earned income, ordinary income, capital gain income, and before the end of the semester, passive activity income, which is yet to come. All right, so back to investment expenses for portfolio investment income. There's strict rules on what's allowed for deductions against portfolio investment income. The investment expenses come in two varieties. One that is clearly an investment expense related to being involved with the investment. They will be subject to the 2% miscellaneous itemized deduction rules. And as you see on the chart in the block that marks investment expense, referring to miscellaneous itemized deductions subject to the 2% floor of adjusted gross income, you will note well at the bottom that if you do not deduct it in the year that you have the expense, you will lose it. And that's not a penalty, it's just the way the tax law works. It's not considered a business loss. It's not considered something that carries over. So if you have it and you get to use it tax-wise, great. If not, it's just the way it is. The final column refers to investment interest expense. When you invest for purposes of making an investment and you borrow to make the investment, so you borrow to make the investment, then your interest expense on those loans will be limited to the investment income for the year, what we call the net investment income. The net investment income is the amount of earned money on the portfolio investment, so it's not earned income, it's the amount of earnings on the portfolio investments reduced by the deductible investment expenses, which leads to a very interesting concept if you're a high wealth individual. So your miscellaneous itemized deductions with that 2% AGI floor means you don't get any deductions for your investment expenses. Then you probably have a little bit more investment income with which to match your investment interest expense in order to be able to take that investment interest expense as a deduction. So and it carryovers indefinitely. Okay. And the interest expense becomes an itemized deduction, not part of the miscellaneous itemized deductions, but under the category of interest expenses. So that's where it will show up. So it will still be a itemized deductions subject to the phase out, or at least part of a phase out for high wealthy individuals, which could be a fairly large phase out of getting to use. You'll use some of it at all times if you have it and you qualify, but you'll lose some of it if your income's high enough due to the reduction of the itemized deductions when you're adjusted gross income goes over certain amounts. All right, so let's see if there's anything else to say about that. There's one more thing which doesn't show up here, but it's fair game, I think, to have it as a question on the final, and that would be that if you borrow money to invest in tax-exempt municipal bonds, if you borrow money to invest in tax-exempt municipal bonds, that investment interest expense is not deductible at all. It sort of makes sense if you think about it, that if your investment interest expense is limited to your investment income, so if municipal bond income is not investment income, it's not taxable investment income. So I think that's the point to make out here is when you see this third column, keep in mind that the limitation is on investment income that is taxable investment income. So excluded from that category is municipal bond income. All right, here's some more definitions. Let's see what this adds that I didn't say, probably a whole bunch. It tells you what gross investment income includes, interest, annuity, royalty income. So this is more of almost a definition or at least a clue as to what it means. Portfolio income includes short-term capital gains and non-qualified dividends. That's good to know. So at least if you have non-qualified dividends, you lose the special preferred capital gain rate, but you get the possibility of deducting more of your investment interest expense, should you have any. Okay, so make sure you understand that paragraph. Taxpayers, here's another explanation of it. That it's carried over, that's important to remember. The carryover never expires until you die. That's still true. And then I included what goes back to really Chapter 7, as it says here in this paragraph. It showed up in Chapter 11 here with a reference back to Chapter 7, so I do a little bit of both. Don't forget the 3.8% contribution tax or Medicare contribution tax on net investment income. Study those rules and just be familiar with the basic idea that if you are making enough money, $250,000 of what they call modified adjusted gross income, so it's going to take adjusted gross income and do something to it, and here it tells you in this paragraph, modified adjusted gross income equals adjusted gross income increased by income excluded under the foreign earned income exclusion, less any, well, I don't think we know what that is, but well, we're not going to learn it, I don't believe, too heavily involved in this course, but needless to say, you now know that when you see the words modified adjusted gross income, you got to find out what does it mean, modified, what is being modified. At any rate, the key here is that making it over $250 if you're filing jointly, or $200 for single taxpayers, if your income goes above that, it's possible that something has to be computed, not possible, something will have to be computed to see if you have net investment income, because if you do have net investment income, it's going to be taxed at an additional 3.8%. And by the way, it was never taxed before. So in years 2012 and before, there was not this 3.8% for these kinds of taxpayers on something called net investment income, which is why I took up the teaching a lot more during the 2013 tax season, which was earlier this year, meaning when we were doing the 2013 tax returns. I didn't want to see some of my clients who were going to be exposed to the 3.8%. I didn't want to have to explain it to them why their tax suddenly was up somewhat significantly from 2012. And the tax is still on the books today, and it is there for all time to come unless Congress comes along and repeals it. And finally, the 3.8% Medicare contribution tax. This defines net investment income, and the key here is all the points are important, but number 2 is a big one. When we get to passive activity income, someone remind me to mention this again. If I don't, I probably will, because this is number 2 was a trade-off during the course of the regulations being written for the Medicare contribution tax. It wasn't quite clear that number 2 should apply, but it does, and we'll talk about when we get there. And that is it, my friends. So let me do this see if I can. We'll see you next time.